Hey guys, how's it going? It's Andy from Magoo Investing. Happy Wednesday. In the past couple weeks, I've been spending more and more time on Wall Street Bets on Reddit. It's kind of a place that gets joked around about people just wasting all of their money, but I've been actually learning a decent amount of stuff on there. I learned about stuff like how Tesla could not be shorted the day after Elon had his breakdown, and that was something that I did not see talked about elsewhere. And I've been seeing some great memes about stuff like Disney falling, where I get memes like this one. And I keep learning about this portfolio that keeps getting talked about, especially after people have these massive losses. And people in the comments go, well, we should have just invested in Becky. In today's video, we're going to be talking about what the Becky portfolio is and how it's always outperformed the overall market since 2016. We're going to break down the individual stocks and just kind of talk about why this portfolio has done so well over the past couple years. Before we get started, I gotta say that I'm not a licensed financial advisor and this is not financial advice. You should do your own research before taking any positions. If you enjoyed this video, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. With that being said, let's get started and talk about the Becky portfolio, the one that has beat the market every year since 2016. Okay, so the general idea of what the Becky portfolio is, it's an investment portfolio that's made up of companies that the stereotypical basic white girls would invest in. So normally how I talk about my criteria for buying stocks, it has to be a product that I use often and I trust. And it seems like the Becky portfolio is made in the same way. And so in this video, I'm going to be breaking down the 8 stocks that make up the Becky portfolio. There have been some other companies like Twitter, Snapchat, Facebook, stuff like that, but I did not include them in this video. When you look at these 8 stocks, you have stuff like Apple, Starbucks, Target, Ulta Beauty, and then it wraps it up with Lululemon, Etsy, Disney, and Planetfitness. These are the 8 stocks that make up the Becky portfolio, and let's start breaking them down. The next thing I wanted to do is backtest these portfolios. What backtesting is basically you put in all of the stocks that make up a portfolio and then you can compare it to the overall market over time. This is a great way to see how your hypothetical portfolio would have done compared to the overall market. Because as we've talked about a lot, the whole idea of investing in specific companies instead of just investing in the S&P 500 is you think that you can outperform it. When we look at the Becky portfolio compared to the S&P, if we invested with $10,000, there's a huge difference in the overall return that you would see. I'm going to leave a link in the first line of the description if you'd like to backtest your own portfolio, because I'd love to see how your portfolio compares to the returns that we've seen with the Becky portfolio. Similar to the stereotypical white girl, they're not going to be deciding which is going to be the largest proportion of the portfolio, and every stock is going to have a 12.5% weight in the overall portfolio. We're going to start on January 1st of 2016 because 2015 is a year where a decent amount of the companies in the portfolio actually IPO'd, stuff like Planetfitness and Etsy. So January 1st of 2016 is where our comparison is going to start. And when you look at the overall returns that you have seen, with Becky you'd have $28,500, and then with the S&P 500 you'd have $15,500. And the difference between the two portfolios is more than the initial investment of $10,000, which is crazy to think about. When you look at the breakdown of how the portfolios have moved, it's at higher highs and then not as bad lows compared to the S&P 500. And when you break it down by a year, you can see how crazy of a return that you've seen with Becky. And then I wanted to test to see how my own portfolio would have reacted. Luckily, the Magoo Investing portfolio has outperformed the S&P, which I would have hoped it would have done, but it has not done as well as Becky. So I'm kind of somewhere in between. I think my portfolio is fantastic, but obviously it has not had the same type of returns that we've seen with this one. All right, let's start breaking down the stocks. I'm going to be talking about the ones that I have not talked about as much on this channel. Stuff like Starbucks and Apple, I'm going to be linking to further videos, and I'll give a brief overview of what I see with the company. First up, I want to talk about Disney stock, ticker symbol DIS. Disney was in the news because they recently released earnings and things did not go very well. They saw more than a 50% decrease in income from their overall parks and stuff like cruises, which makes a lot of sense. They saw a 90% drop in earnings from what they saw the quarter before, and that is a massive drop. People thought the company was going to be doing all right because of the expected huge increase in Disney Plus subscriptions, but the huge hit where it comes from the parks and the cruises seemed to be really affecting the company. They also announced that they're going to be suspending their semi-annual dividend, which is going to save the company around $1.6 billion. So the company seems to be taking actions to protect themselves for the long run, and that comes at the expense of the shareholders by cutting that dividend. After the earnings report, the company fell, but looks right now this morning that the company has recovered a little bit on Wednesday, and currently the company is down 28% year to date, which is not ideal. Looking at the 5-year chart, I was kind of surprised that Disney is down during that time period. This is a massive blue chip company that I know has done really well in the past year, and I was just kind of surprised that over the past 5 years, with this 28% drop, the company is down overall, which I was pretty surprised about. For a well-established company like Disney, it seems very attractive to potentially take a position. Their current price is sitting around $150, which is significantly lower than their recent highs, and that makes it very attractive for buying a massive company like Disney on a discount. When I show the 1-year chart, you can see the crazy jump that the company saw in 2019 and how it's fallen from those highs. Looking at their fundamentals, they have been a very solid company at increasing their revenue over time. That's something I really like looking for, especially for consistency. And they've been increasing their cash on hand recently up to $6.8 billion, which is very nice to have. However, with a company that has so many different holdings like Disney, they have a lot of long-term debt. Currently, their long-term debt is around $38 billion, and that's up from $17 billion just a couple years ago. So they have been increasing their long-term debt significantly in the past couple years. Overall, I think Disney is a fantastic company to invest in, especially at discounted prices like this. Similar to what we're going to be talking a lot about in this video, companies like Disney are very dependent on the overall state of the economy. And now with lockdowns affecting their overall park revenue and their cruise ship stuff, it makes a lot of sense why they've been hit pretty hard. And so I think this could be a great buying opportunity. The company seems to be a little tight on cash, which is why they're closing down their semi-annual dividend to save money. And so I think the company is definitely going to survive through this and things are going to be great. And so this could be a decent opportunity to take a position in a blue chip like Disney at a 28% discount. Once the US gets back and running again, I expect Disney to go back to their recent highs, and that's why I think Disney is a great opportunity. Let me know what you think about Disney stock, ticker symbol DIS, in the comment section down below. Next up, I want to talk about Target, ticker symbol TGT. Target is one of those companies that I didn't really pay that much attention to. At the beginning of the market crash, I talked about places that I was looking to invest, and stuff like Walmart was something that I was really attracted to because they have done so well during a time like this. And looking at Target, you can see some of these same ideas apply to them. When you look at the 1-year chart, you can see that it fell pretty heavily during March. Currently, the stock price is around $130, and looking at the price movement that it's seen in the past, I think that's a pretty fair value. Looking at their fundamentals, they have more than $2.5 billion in cash on hand, but they have a lot of long-term debt. This is similar to something that we've seen with Disney. With these massive stores and how many different locations they have, it makes a lot of sense that they have a lot of debt associated with the company. Looking at some of the news reports that we've seen from this lockdown is that they saw a 7% increase in sales at individual stores, which I thought was very surprising. And their online sales have doubled during this time. There seems to be a large demand for the company still, and so even though they're very reliant on their physical stores, that double in the online sales is very attractive. It makes it seem like I'm not super worried about the company getting hit really hard during these tough times. They have talked about some problems that they've been seeing with increasing labor costs, and they haven't been selling as well on the high margin items that they normally would. So some of the earnings are probably not going to be as good as they have been in the past, but it seems like their sales are still keeping up decently well, and I'm not super worried about the long-term ramifications of this lockdown. Looking at the recent price movement of the company, it's down 9% year to date. So you're still getting a decent discount, nowhere near the 28% that you would get with Disney. But for a company that I think is pretty well set up to do well during this lockdown time, I think 9% is a pretty decent discount. Target is a company that I think is very good at what they do. And similar to Walmart that I've talked very well about, I think they share a lot of these same characteristics, which is why I think that Target could be a great buying opportunity. Let me know what you think about Target stock in the comment section down below. Next up, I wanted to talk about a company that I have never used in my entire life, and that is Ulta Beauty, ticker symbol ULTA. Currently, the stock price is around $220 and it's down 14% year to date. And so when I first saw that and knew of them as a physical retailer, I was initially expecting to see a lot of negative things when I did research for this company. However, the research that I've done has made me feel very bullish on the company overall. One of the most attractive things that I saw is that 90% of their stores are not involved in these massive malls. And if you've been paying attention to physical retailers at all over the past couple of years, the reliance on malls have been decreasing over time. And it seems like a really massive benefit to not be associated with them. And so 90% of their stores not being associated with them makes me feel very good about the long-term potential of this company. Also, I saw a lot of articles talking about the loyalty of their consumer base. I saw that 90% of their revenue, 90% came from their loyalty members, which was an incredible number to think that 90% of their overall sales came from people in their loyalty program, which I have not seen a lot of numbers about other companies, but 90% seems ridiculous to me. In the past couple years, they've seen their guest return rate double and their average transaction go up 300% since 2017. And those are all numbers that you want to see for a company that you're investing in for the long term. When you think about struggling retailers like JCPenney, Macy's, and GameStop, they have all looked like they're going to be heading towards bankruptcy, and I do not see that happening with Ulta. Based on my criteria that I use to pick out stocks, being it has to be a product that I use regularly, this is not something that I can make my own opinion on. So if I reached out to my girlfriend and everything I've heard about Ulta has been positive, it could be a part of my portfolio in the future. However, this is a company that's going to be pretty reliant on how soon the US opens up. I saw that they have a decent amount of online sales, but I saw a lot of information talking talking about how good they are at increasing their sales for people that are actually in the store. So until the US finally opens up fully, this is a company that'll be on my watch list and I will be waiting to take a position on in the future. Let me know what you think about Ulta Beauty in the comment section down below. Next up, let's talk about Planetfitness, ticker symbol PLNT. This is a company that's currently trading around $55 and is down around 22% year to date. This is a company that recently announced their earnings, and they missed on both the earnings and the revenue aspects of it. They saw a 14.5% drop year over year in their revenue, which makes a lot of sense based off of the reliance on people actually being in their locations. This is a company that's very reliant on franchising, and there was an 11% drop in revenue for the franchise locations, but they saw a 5% increase in the revenue from the corporate-owned locations, which I thought was kind of strange. I'd love to see more of an explanation on what happened there. Some of the biggest drops were seen in their equipment sales, which were down 37% year over year. This makes a lot of sense. They're mainly selling towards their own franchises, and during a time of economic uncertainty, it makes a lot of sense that these franchises want to be saving money and are not spending on more equipment for their locations. The corporate wing of the company has furloughed all of their employees except for the store managers, and things were not looking too good. And then April was a bounce back for a lot of stocks. There seems to be a lot more optimism that the US is going to start opening up sooner, and the stock jumped more than 20% in the month of April. This seems like a pretty risky investment to me. Depending on how long this lockdown goes, the company is going to be hit pretty hard. But there are some really positive things that I see about this company over a lot of others. And the main thing is that if things start opening up, consumer spending is going to be down a lot, and you're going to see that across the board. With their business model on being very cheap and affordable, I think that they'll do pretty well during a time like this. I don't think people will be going out and upgrading to these massive luxury gyms. I think places like Planetfitness are not going to see a huge drop in their customer base just based off of their affordability. However, as I mentioned, the longer this goes on, the worse it's going to be. So that's something that you're going to have to take into account if you look to take a position in Planetfitness. Let me know what you think about Planetfitness for a long-term play in the comment section down below. Next up, I want to talk about Lululemon, ticker symbol LULU. This has been a company that pretty much any time I've heard someone talk about it, it's only been positive things. They seem to be into the luxury apparel line, and everyone seems to love their products. Currently, the stock is sitting around $225, and it's down around 3.5% year to date. Looking at Lulu compared to the overall market, they have done significantly better than the overall market, where they increased 18% in the month of April when the S&P saw an increase of 13%. At this point, we're not going to see earnings until the beginning of the summer, so there's not a lot to go on. But as I mentioned, the determining factor is how long is it going to be until the economy starts opening up fully. Looking at the one-year chart, you can see the crazy sell-off that they saw during the month of March, with the company going down to $140, and it has bounced back very well since that point. When you look at the 5-year chart, you can see the ridiculous returns, which makes sense for why Becky has been doing so well, with the company being up 240% over the past 5 years. At this point, I don't really have a lot to say about places like Lululemon. They seem to be selling luxury goods, which usually do not do super well during times of a recession, which we are potentially going to be seeing in the future. But they seem to have a loyal consumer base, which is always a positive during uncertainty. So I'm kind of 50-50 on this one. There's been some incredible returns over the past 5 years, but I don't think I can pull myself to taking a position in a company that I don't actively use. Let me know what you think about Lululemon stock in the comment section down below. Next up, we're going to be talking about Etsy stock, ticker symbol ETSY. This has been the best performing stock this year, with the company being up 71% year to date, which is some ridiculous returns. When I think about companies that have been doing very well this year, I think about Etsy and I think about Zoom. And seeing Etsy being up 70% makes a lot of sense. During times like this where people cannot go and actively shop, Etsy focuses on handmade products. And so people are spending a lot more time inside and probably spending a lot more time online shopping. And so it makes sense that their products have been selling more than usual. I talked about eBay at the beginning of this lockdown about being a potential great play. And while that's done pretty well, it's only up 13% compared to what we've seen with Etsy up 70%. Looking at the one-year chart, you can see that the stock has broken through 52-week highs, and then with the 5-year chart, they've broken through a resistance that was seen at the beginning of 2019. So at this point, for a technical trader like myself, there does not seem to be a lot of reasons to take a position in a company that's moved up this fast already. Obviously, there's been ridiculous returns of 70%, but I think it's always good to make sure you aren't chasing companies that have already taken off, and 70% is a massive increase. Taking a position in this company is very risky. At this point, we have not seen the earnings report, which actually come out today. So at this point, we have not seen how the numbers look for this last quarter. Obviously, this has been the best performing company in the Becky portfolio, and 70% is a ridiculous return over many years. So seeing that in just a couple months is making me very fearful for taking a position in this company. If I wasn't involved in it already, I would not be buying this stock at all. Let me know what you think about Etsy stock in the comment section down below. There are two companies left on this list, which are Apple and Starbucks. These are two companies that I've talked about heavily in the past week. I talked about Starbucks in its own video, and I'll link that above right now. Basically, what I have to say about that is Starbucks got hit very early based off of the virus because they were the first US company to come out and talk about the potential danger associated with it. And so when you look at the one-year chart, you can see that the decline started at the end of January. And I think this is a company that will do very well based off of their exposure to the Chinese market. At this point, the company is down more than 20% year to date, and things do not look very good when you look at the chart. But I think the fundamentals of the massive amount of cash that they have on hand and that exposure to the Chinese market makes it very beneficial for a long-term position. This is a company that I own and I've recently added to my position. Let me know what you think about Starbucks stock in the comment section down below. And then last up is Apple, ticker symbol AAPL. I also made a video about this and I talked about it heavily for my top stocks to buy, and I'll link that above right now. Apple is a company that I do not love based off of the fact that 50% of their revenue comes from iPhone sales. But the trend that you've been seeing has been an increase in their revenue from wearables and their overall service industry. So I see the positives from there. This is a massive company that's pretty even on the year. This is a company that I'd happily add to my portfolio, even with some of the bad things that I've said about it. I'm just kind of nitpicking some of the things that I think are holding the company back for the long term. Apple is a massive company, and adding it to pretty much any portfolio would be a beneficial move. Let me know what you think about Apple stock in the comment section down below. Overall, this portfolio is a lot of companies that I have never really looked at in the past. Stuff like Etsy, Planetfitness, Lululemon, Ulta Beauty have been kind of on my radar. I knew of them, but I've never really looked at them. Some of these companies I see a lot of benefits with, especially with Ulta and their loyal consumer base. Looking at these stocks, considering the returns that you've seen with the Becky portfolio, it makes sense that a lot of them have been doing pretty well. And so looking at this portfolio, I see a lot of risk in the future. There's a lot of reliance on physical retailers, which seem to be kind of risky in the upcoming months if we do see a recession happening. But as we've seen with the returns, they've had incredible past couple years. And while past returns don't show what's going to happen in the future, seeing that it's beat the S&P 500 every year since 2016, you kind of have to step back and look, are these companies that I should be investing in? There's not stuff that I actively use, but the results that you've seen with this portfolio are ridiculous. So let me know what you think about the Becky portfolio in the comment section down below. Thanks for watching this video, stay inside, and I'll see you in the next episode.